When do I pay tax on cryptocurrency? Digital currency trading has grown significantly in the UK, attracting increased participation in investment, trading, and profit-making through a variety of virtual assets. HMRC expects tax to be paid on capital gains or income from cryptocurrency. You can use any losses to reduce your tax liability. How you have made money from crypto determines the type of tax you may need to pay, either capital gains tax or income tax. Understanding tax on cryptocurrency is important, so you know how to calculate your gain or loss and the rate of crypto tax payable to HMRC. Some crypto traders remain unaware that crypto profits incur tax liability and that omitting to declare gains risks HMRC penalties. By staying informed about HMRC cryptocurrency tax guidelines and maintaining accurate records, you can ensure compliance and potentially optimize your overall tax position. Our Tax on Crypto Guide will walk you through key essentials of crypto taxation in the UK, ensuring you're well equipped to handle your tax obligations. For individuals, your crypto activities could be subject to two main types of taxation. Capital gains tax, or CGT, applies when you make a profit from selling or trading your cryptocurrencies. The second type of tax is income tax, which is relevant for earnings from crypto activities like mining, staking, or receiving payments in cryptocurrency. Let's break down each of these in more detail. Calculating crypto capital gains tax. Cryptocurrency capital gains tax applies when you dispose of your digital assets, including selling, trading, or gifting to someone who isn't your spouse or civil partner. The annual tax-free allowance is £3,000 per year. CGT rates depend on your income tax band. Both the CGT annual allowance and rates are subject to change. Basic rate taxpayers have a CGT rate of 18%. Higher and additional rate taxpayers have a CGT rate of 24%. Let's look at an example. Say you bought one Bitcoin for £20,000 and sold it later for £30,000. Your gain would be £10,000. After deducting the £3,000 allowance, you'd pay CGT on £7,000. If you're a basic rate taxpayer, your CGT bill would be £1,260. When is income tax payable on crypto? Income tax typically applies when you earn returns from particular crypto activities. The majority of cryptocurrency earnings must be declared as miscellaneous income and are taxed at your standard income tax rate, calculated using the pound sterling value at the time of receipt, after deducting any eligible expenses. Crypto income is taxed at your regular income tax rates. Basic rate is 20%. Higher rate is 40%. Additional rate is 45%. HMRC guidelines state that the following transactions are generally subject to income tax: receiving cryptocurrency as payment. Other transactions subject to income tax can include earnings from mining, income from staking, returns from liquidity pools, profits from lending, and certain airdrop receipts. Mining and staking rewards are considered income at the GBP value when received. If you later sell these coins, you may also need to pay CGT on any increase in value. Here's an example. If you earn £5,000 worth of cryptocurrency from staking and you're a basic rate taxpayer, you'd owe £1,000 in income tax, which is 20% of £5,000. Crypto capital gains tax annual allowance. You can use the capital gains tax annual allowance against crypto gains that are liable to CGT only. There isn't a separate CGT annual allowance just for gains from crypto assets. Any gains from other sources from the same tax year will need to be considered when using your CGT allowance. Crypto losses can be used to offset other capital gains in the same tax year, or you can carry them forward to be used against a future gain. Crypto trading allowance. A yearly trading allowance of £1,000 per person is available to use against crypto trading and miscellaneous earnings that are subject to income tax. When your combined trading and miscellaneous revenue from all sources, not just crypto, in a tax year falls below £1,000 and you're not otherwise self-employed, this income is income tax exempt. HMRC cryptocurrency tax guidelines treat some digital assets as property for tax purposes. Here are some key points to remember. Each crypto-to-crypto trade is a taxable event, not just crypto-to-fiat conversions. Simply buying and holding crypto doesn't trigger a tax event. You only pay tax when you dispose of your crypto assets. Using crypto to purchase goods or services is considered a disposal and may be subject to capital gains tax. NFTs are generally treated like other crypto assets for tax purposes, subject to CGT on disposal and potentially income tax, if received as income. The same-day and 30-day rules usually apply when calculating capital gains, similar to share trading. How to report crypto gains to HMRC. HMRC has data sharing agreements with UK crypto exchanges, tracking transactions back to 2014. Learning how to report crypto on taxes in the UK is crucial for compliance with HMRC regulations. Here's a step-by-step process. Keep detailed records. Track all your crypto transactions, including dates, amounts, and values in GBP. Calculate your gains and losses. Use the HMRC's share pooling method to calculate your overall gain or loss for the tax year. Complete your tax return. Report your crypto gains on the Capital Gains Summary section, SA 108, of your self-assessment tax return. Report crypto income. If you've earned crypto through mining, staking, or as payment, report this in the Additional Information section of your tax return. Meet the SA deadlines. As an example, for the 2024-25 tax year, the deadline for an online tax return to be submitted is January 31st, 2026. HMRC would expect any income tax due to be paid by the same deadline. UK crypto tax regulations. What investors need to know. UK crypto tax regulations are evolving, with HMRC providing increasingly clear guidance for investors. Here are some key points. Airdrops are taxed as income if received in return for a service, otherwise may be subject to CGT when sold. Hard forks. New coins received are not immediately taxable, but may be subject to CGT when disposed of. Lost or stolen crypto. You may be able to claim a capital loss, but evidence is crucial. The crypto tax landscape in the UK continues to evolve, with HMRC having to adapt their guidance on areas like DeFi activities and NFTs. Future regulations around stablecoins and CBDCs, central bank digital currencies, are also expected. Stay informed about these changes to ensure ongoing compliance with UK crypto tax regulations. You can use the HMRC Crypto Assets Manual to find up-to-date information on their legislation for tax on cryptocurrency. Proper record keeping is essential for accurate tax reporting. Here's what you should track. Transaction dates. Type of transaction. Number of units involved. Value of the transaction in GBP at the time. Cumulative total of investment units held. Bank statements and wallet addresses. Crypto exchanges let you keep track of your transactions and maintain most of the records you need for tax purposes. Using a cryptocurrency tax calculator can help you estimate your tax liabilities accurately and ensure you're keeping the right records. There are a number of crypto tax software options available which can help you manage your record-keeping and tax obligations. Cryptotax software typically lets you import your crypto trading history to help calculate your tax position. Third-party cryptotax software is usually pretty straightforward for the end user and can integrate nicely with any accountancy packages you already use. Some crypto transactions don't incur a tax charge, including purchasing crypto. When you purchase digital currencies and maintain ownership, commonly referred to as hodling, this transaction isn't subject to taxation while you retain the assets. Buying crypto with GBP. If you buy cryptocurrency using British pounds, no tax applies at the point of acquisition. Transferring crypto. Moving cryptocurrencies between your own personal crypto wallets and accounts doesn't trigger any tax obligations. These movements are tax-exempt, as they're not considered taxable events. Maintaining detailed records of all transfers is vital for tax purposes and prevents any misclassification of these transactions as disposals. You can find out more about tax rebates, and use free tax calculators at taxrebateservices.co.uk. The content used in this video is intended for educational and informational purposes only and does not constitute advice. We recommend that you do your own research on each subject and take advice from HMRC or a professional tax advisor